welcome to Indianomics. Next week, the MOSPI, or the Ministry of Statistics, will announce the fourth quarter and the full year GDP for last year, FY24-25. The CNBC-TV18 poll shows that the GDP for the fourth quarter grew by 6.8%, much stronger than the 6.2 in Q3, 5.6 in Q2, and 6.5 in Q1. GVA growth, gross value added growth, will be more modest at 6.5%, or 6.2 Q3, 5.8 in Q2, and 6.5 in Q1. For the full year, our poll, that is for the current year, our poll threw up a GDP growth of 6.3% only. That is the FY25 poll, compared to MOSPI's estimate of 6.5. We are still speaking FY24-25. And last year, of course, FY24, it was a solid 9.2%. Now coming to the current year, FY25-26, our poll threw up a number of, again, 6.3%. This compares with the Reserve Bank's forecast of 6.5%. Now, let's go back to FY25. If FY25, the numbers are way below even our poll's estimate of 6.3%, that can move the Reserve Bank to cut rates a little more aggressively. So the Q4 numbers are important for the upcoming Reserve Bank policy. It's the last data Reserve Bank gets before it goes into policy. Hence, to understand more as to what to expect, I have with me an elite panel of economists: Kaushik Das, the chief economist at Deutsche Bank; Aurodeep, Nandi, the economist from Nomura, India; and Anubhuti, Sahay of Standard Chartered India. Gentlemen and Anubhuti, thank you very much for your time. Kaushik, well, the first question will be, we had a terrible shocker in the second quarter when we saw 5.6%. 6.8 is very respectable. Can you stand by that number? Have we seen enough evidence for such a strong growth?
Good morning, Latha. Our forecasts are exactly what you have just talked about, that our real GVA growth is around 6.5 for January, March of 25, and the real GDP growth is 6.8. As you mentioned, that this is coming from 6.2 in October, December, and the shocker that we got 5.6. Whatever I've seen in the leading indicators, I think we will get some sequential improvement in real GVA, which is more easily understandable and probably show some improvement. Now the GDP calculation is more tricky because it brings in this element of calculating net taxes, subsidies. And what I just calculated and saw is that subsidies were down in January, February by about 34%, and January, March, my estimate is subsidies will be down minus 40%. So it is possible that you could get a little bit of improvement in the real GVA to 6.5, but my guess is that your real GDP growth could be even higher than 6.8, probably higher than 7% if these subsidies remain negative. If you remember that the CSO's implicit estimate for January, March GDP growth is 7.6, and that's why they've given that 6.5% average growth for FY25. We are at 6.3 because we have 6.8% for real GDP growth. I will stand by that, but I think the risk is more to the upside than the downside.
Oh, that's good news. I will come to what the Reserve Bank will make of it. But it is important to remember that the MOSPI's subtraction, if you subtracted from their full year number, we did get a 7.6 for the Q4. So the upside surprise is possible. But Aurodeep, you do a heat map. I remember it was very popular with us during COVID. Now, the crop figures for the first count didn't sound very good, if I remember right. So can there be that kind of disappointment, agriculture or something?
Well, Latha, on the supply side, I think it's going to be better news because Rabi crop production has been good, so agri GVA growth should be fine. However, industrial growth, I think, is going to be weaker. We see this also in the IIP numbers, and services we expect should be better. The heat map that you refer to, if you in fact look at how consumption indicators have done this quarter on a year-on-year basis, it's actually moderated. We do a coincident activity indicator growth, and I mean, we are expecting that there should be moderation in private consumption. possibly moderation also in investments and exports. However, imports, the negative part of it, is likely to be higher, so more negative numbers. So the GDP growth number picks up. Also, the point which Kaushik mentioned is really important, which is the sort of GDP's GVA plus net indirect taxes. So the improvement in GVA is it's incremental, 6.2 to 6.5%, and then you have also this arithmetic component that boosts up.
Yeah.
GDP
The
growth.
GDP, yeah. Okay, so are you also saying that an upside surprise to 6.8 is possible?
I mean, our baseline number is 6.7%.
Okay.
Again, there is a lot of volatility in the way GDP numbers come out. So,
Yeah.
I mean, that could be the case. But overall, I mean, I would be focusing more on the components of growth. And there, if consumption is weakening and investments is weakening, I think that's the story to look at.
Okay, got that. I agree with you on this volatility of numbers. Anubhuti, to you, two questions. One, the GST numbers were still quite strong, so indicating that consumption should not disappoint. What are your thoughts on what might boost the GDP? And I think the more important worry for all of us is whether previous numbers will be recast. Any light you want to throw on whether they will upgrade Q2 numbers, which was the big disappointment? Any such expectations or fears?
Sure, Latha. So I think on consumption part, the first question which you put forth, I think, if we go by the broader set of indicators, we have a composite indicator and it tracks the non-agri and non-GVA growth, GDP growth pretty well. And it has stayed absolutely flattish vis-a-vis where it was in the December quarter. So there is no uptick to say so. Even if you look at, say, retail digital payments, which RBI gives, and club it with cash, cash transaction or ATM withdrawals by retail, it has actually decelerated. So it was averaging at close to 20% for the first 3 quarters of FY25. And in the last quarter of FY25, it has actually dropped all the way down to 14%. So I really don't see possibility of consumption actually surprising on the upside. It might be actually lower, and that would.
No, I agree with you. On at least two-wheelers, I clearly remember Jan, Feb, our analysts were grumbling about two-wheeler sales not being good. So, okay, so you worry that Q4 consumption may be lower. Is your overall number therefore lower?
Yes, it is lower, Latha. So, based on what even Aurodeep mentioned, so consumption, if we go by on-the-ground indicators, doesn't show an uptick. Investment, yes, government started spending, but would it have been a massive increase? I doubt. So our GDP forecast is at 6.5% for the last quarter, and GVA is 6.2. But the GVA is also getting a lot of support in our view from agri. Last March, agri growth was just at 0%. So there is a favorable base effect, and a modest uptick in output can also make it look better. On your second question, I really don't know how the growth numbers would get revised for the last 3 quarters. There have been massive revisions, but it's highly possible that we might see an upgrade in the second quarter, GVA as well as GDP number, because usually in the past, if you look at analyst forecast, the first print of GDP and then, the subsequent revisions, I think then the error margin reduces. It was a shocker, so it's possible that we might see an upgrade there. And therefore, the growth rate across the year might look far more uniform than what we think at this point in time.
Okay. I will come back to the revisions to both of you in a minute. But I think the more important point is the upcoming policy. Kaushik, are there any likely downside surprises or shocks that might propel the Reserve Bank to be even more dovish? At the moment, they have a lot of support from the inflation numbers. For the full year, it is expected to be under 4%, so they have that confidence. But if growth doesn't need a crutch, you don't need to cut so much. So do you think there can be any shockers, any inputs from the GDP numbers for Reserve Bank?
So, Latha, optically, suppose you get a number like 7.5% on GDP, which say CSO is implicitly, showing in their forecast. Obviously, that will make markets a bit cautious about the fact that is growth that kind of, on a slowdown path that people had thought? And then people will also think about FY26, given that there's been a reversal of tariff for China. Generally, the mood is becoming, more positive than what it was. So all these things can happen, but we also got an inflation number which is pretty low, and it'll remain like that. So if you think about RBI in the June policy, they will have to reduce their inflation forecast from 4% to, our current forecast is 3.5. I don't know whether RBI goes that low, but they definitely have to lower their forecast. GDP, I think, will not touch at this point of time, just having revised from 6.7 to 6.5. But on the margin, you're still revising inflation lower. And the fact that you've turned accommodative in April, so suddenly in June, if you come and pause and, you say that, for whatever reason, you're not doing a rate cut, that will be more confusing, particularly because you've turned accommodative. So I have a call for June 25 basis rate cut. But the fact that RBI, in your own calculations, which I read very carefully, and it was a nice analysis of the dividend that RBI is expected to pay, I think it'll be a big number, and you'll have an effective easing of another 25 basis points through the liquidity channel. So in June, probably you'll get almost 50 basis points rate cut, 25 through the repo rate and 25 through liquidity. So that's why I have a forecast of August, RBI remaining on a pause and not doing anything. And then if required, then in October, they'll go for another last 25 basis points rate cut, bringing it to 5.5 repo rate. And, I've written in my report that, RBI probably will not go below 5.5, because even at 5.5 repo rate, your short-term rates fall to 5.25. That's good enough. One pointer, Latha, if I may just add to this debate about the GDP growth, which can inform your discussion as well.
Sure.
In 2019 calendar year, when Governor Das had started cutting rates from 650, they had brought it down to 515 by the end of 2019. You'll see that year, the calendar year growth average was 4.7% real GDP. This time we are talking about, even if growth slows down and say it goes to 6%, it is still 130 basis points higher than that below 5% growth. Why should then the repo rate go down to 515 when your growth rate is between 6 to 6.5%? So that's why we think the terminal repo rate should be 550, and the short-term rates can come down a little bit more because of the liquidity that RBI will be infusing through the dividend and what they have already done through the OMO channels.
Okay. Well, I want to come back to the policy discussion, but let me quickly get one future angle in as well, which is the current quarter. Aurodeep, of all the numbers, I find yours more pessimistic. Your, or rather, maybe realistic, who knows. Your forecast is 6%, and for the full year, you all stand at 5.8. Now, I would assume these are the global headwinds. But we've got this China rate cuts coming in. We've got, as Kaushik pointed out, huge liquidity infusion by Reserve Bank, as if what is already available is not enough. Today, the call rate is not where the repo rate is. It is at 5.75. It is already a 25 basis cut as far as the call rate is concerned. So would you want to upgrade, or do you still think that there are chances of a slowdown in the current year?
So first thing, Latha, global growth is one of the factors. The other factor is that urban consumption has been weak. It's not like we are seeing great income growth happening. And let's not forget, there's household balance sheet stress that is still there in the system. Also, private capex hasn't really recovered, and in a place where there's so much uncertainty both on the domestic and the global side, there is a big question of how much that capex recovery will happen this year. So the fact that we are below consensus is not just because of global growth, but because also of domestic factors. That said, you're absolutely right. Policy has turned counter-cyclical. Also, rural consumption doing better. There is the whole China plus one shift of supply chain to India. So there are positives, no doubt. But things like rate cuts, things like excess liquidity in the system, these will take time to transmit for credit growth to eventually pick up. So probably in the second half of the year, we will see that play through. But overall, we still remain bearish at 5.8%.
Okay, so the Reserve Bank will watch out for all that. I have to take a quick commercial break, but I need Anubhuti and Aurodeep's views as well on what the Reserve Bank might do with this GDP numbers, as well on other nuances that we have to watch out from the May 30th data. Back in a minute.